If you're a trader, you know that timing is pretty much everything. Well, today we're going to break down two really popular tools that can help you with exactly that: Williams percent R and the relative strength index, the RSI. We're going to see what they are, how they're different, and hopefully help you figure out which one might be the right fit for your strategy. So let's be real. Every single trader has asked this question. You're in a great trade, the trend is your friend, everything's going up, but that little voice in your head starts nagging you. How much longer can this last? Knowing when that trend is about to run out of steam, well, that can be the difference between a great trade and a frustrating one. And the answer to that nagging question? It all comes down to one simple word: momentum. You can think of it like the engine that's driving a stock's price. What we need are some gauges on our dashboard to tell us when that engine is starting to sputter before the car comes to a dead stop. And that's exactly what these two indicators are designed to do. Okay, so here's our game plan. First, we'll talk a bit more about gauging momentum. Then we'll get properly introduced to Williams percent R, and then we'll do the same for the RSI. After that, we'll put them side by side for a head-to-head comparison, and finally, we'll get into their shared superpower, which is spotting trend reversals. Let's get into it.
So, at their heart, both Williams R and the RSI are what we call momentum oscillators. I know, it's a technical sounding term, but the idea is actually super simple. Their job is to help us figure out when a stock might be overbought, meaning it's stretched too high, too fast, or when it's oversold, meaning it's been pushed down too far and might be due for a bounce.
Probably the easiest way to get the difference between these two is with a simple analogy. Think of Williams percent R as a snapshot. It tells you right at this very moment where the price is sitting compared to its recent high and low. The RSI, on the other hand, is more like a report card. It looks back over a period and grades the consistency of the price moves. It's asking how strong were the up days versus the down days. All right, let's start with Williams R, our market snapshot. Let's pop the hood and see exactly how this thing works.
Okay, so here's the textbook definition. It's measuring where the last closing price is in relation to the entire trading range, from the absolute highest high to the absolute lowest low, over a certain number of days, usually 14.
Now, this is the first thing that trips people up with Williams R, and it's super important. The scale is, well, it's upside down. It runs from 0 down to -100. So a reading of 0 doesn't mean nothing. It actually means the price is at the absolute highest point it's been in the last 14 days. And a reading of -100 means it just hit the absolute lowest low. The key halfway point is -50. If the reading is above that, the price is hanging out in the upper half of its recent range. Okay, let's switch gears. We've seen the snapshot. Now let's look at the performance review, the relative strength index. See, with the RSI, the magic word is consistency. It cares less about where the price is right now and a lot more about the character of the recent price moves. It's always asking, over the last 14 days, how have the up days stacked up against the down days? And right away, you'll notice something much more familiar. The RSI uses a normal, straightforward 0 to 100 scale. No inverted weirdness here. The higher the number, the stronger and more consistent the upward momentum has been. And just to give you an idea, an RSI reading of 100 literally means the price closed higher every single day for the past 14 days. Now that's what you call persistent buying. All right, we've met them both. Now it's time for the main event. Let's put them side by side and see how they really stack up. This is where you'll start to see which one might be better for your own trading. This table really breaks it all down, doesn't it? First, you've got the scale. Williams percent R is inverted, 0 to -100, while RSI is standard, 0 to 100. Then, what they measure. Williams percent R is focused on the price's location in its range, while RSI is all about the consistency of the moves. And finally, and this is maybe the most practical part, the signals. For Williams percent R, you're looking for overbought conditions above -20 and oversold below -80. With RSI, the traditional zones are over 80 for overbought and under 20 for oversold. These are the areas where traders start paying very close attention. So yeah, they're pretty different in how they work, but here's the cool part. They share a secret weapon, a superpower, and that is the ability to spot something called divergence. And let me tell you, this is one of the most powerful warning signs you can get that a trend might be about to run out of gas. So what on earth is divergence? Well, it's exactly what it sounds like. It's when the price chart is telling you one story, but your momentum indicator is telling you a completely different one. For instance, the price might be pushing up to make a brand new high, but the indicator is actually making a lower high. It's a disconnect, a disagreement. And that disagreement is a huge clue that the momentum behind the trend is starting to fade. So here's a perfect example of what to look for. See how the price itself keeps pushing higher, making a new high? That looks strong on the surface. But then you look down at your indicator and it fails to make a new high. It's actually moving lower. That's your signal. That's the divergence. It's like a flashing warning light on your dashboard, suggesting that the buyers are getting tired and a reversal might be coming up. So here's the bottom line. Both of these indicators are fantastic tools for measuring momentum. They're just telling the story from slightly different angles. Williams %R is your fast, sensitive snapshot of where the price is right now. RSI is your smoother, more methodical report card on how the trend has been behaving. It's not about which one is best, it's about which story you need to hear for the trade you're in. And that really brings us to the final question, the one you need to ask yourself. What kind of trader are you? Do you need that hyper-responsive, in-the-moment snapshot that Williams R gives you? Or does your strategy benefit more from the smoothed-out consistency check you get from the RSI? There's no right or wrong answer here, but knowing your own style is the key to choosing the right tool for the job.